quick introduction about our speaker, Mr. Jintek. He's an economist in the Emerging Asia Economics and Policy Research at JP Morgan, with dedicated coverage to Thailand, Philippines, Vietnam, and Pakistan. He has prior work experience in the institutional investment space in Malaysia, where he was an economist at Kazansa and a portfolio strategist at KWAP. Zintek graduated from the Stanford University with a bachelor's degree in economics and holds a CFA charter. With this introduction, ladies and gentlemen, put your hands together to the special keynote address on the opportunities and concerns in ASEAN.
My name is Jintek, and I'm from the ASEAN Economics Research Team here at JP Morgan. Thank you for the very kind introductions over here. I must say it's a real privilege and honor here to be given the opportunity to deliver the keynote address at such a high-level, prestigious forum like the APPMC this year. So what I want to kind of do here for the next 30 minutes or so is just to walk you through JP Morgan's latest global and regional macroeconomic outlook. I understand the title has changed a little bit because I've sort of submitted the slides a little bit late. Yeah, I mean, we also want to offer our latest take on precious metals, specifically gold. So, I think, one of the big sort of surprises that we have from the macro front for the past couple of years is just how resilient the US economy has been, right? And the US economy has really been driving global expansion for the past 12 to 18 months. And this is despite what obviously everybody knows, one of the tightest and one of the most aggressive monetary tightening cycles from the Fed since the 1980s. As you can see here on the right chart, because the data has been so exceptionally strong, the US economics team have sort of been forced to upgrade our US GDP forecast quite consistently since the early part of 2023. And so if you look at the left chart over there, it's a little bit complicated, but what we're trying to say here is that we have basically given more than a 50% probability for the global expansion to continue through 2025, even though we have sort of a higher for longer interest rate regime. And, we just want to walk you through a few possible explanations why the US economy has been so resilient. Is this time different? Famous last words, hopefully not, but it could be different. One of the reasons is that the so-called starting conditions of the US economy has been much better than previous rate hike cycles. If you look at the left chart over there, this is the US corporate debt to GDP ratio. If you look at the blue line, it has actually come down quite a little bit since the pandemic, meaning to say that the US corporates have actually managed to deleverage, sort of taking advantage of zero interest rates during the pandemic to refinance and even to pay down debt in advance, right? And so almost like we are in a new credit cycle right now, at least for the US corporates. Obviously, from a levels basis, things are still very elevated, but this is a key difference between now and also previous rate hike cycles. In previous rate hike cycles, the Fed will obviously hike because of inflation, and usually that's when balance sheets are stretched, and the pass-through from rate hikes to balance sheets will be greater. But apparently, this is not the case this time around. And if you look at the right chart over here, US corporate profit margins have come down a little bit because of inflation, higher input costs, higher cost of labor, but it's still elevated on a historical basis, right? And so with pretty cushy sort of profit margins, I would say especially among the large listed US corporates, there's really no need for them to retrench workers, which is why we see the labor market in the US is still chugging along pretty well. Now, the second reason why this time could be different, and this is related to the first point, is that the so-called monetary pass-through from rate hikes to the real economy has been much softer this time around. If you look at both charts over here, this is basically, Fed funds rate versus the debt service ratio for both households and corporates. It's quite stunning to see, especially in the left chart over there, that the household debt service ratio has barely moved despite very sharp interest rate increases. And I think the key reason here is because a lot of home buyers have managed to refinance their mortgages at really low interest rates during the pandemic, 2020, 2021, and because mortgages are long duration sort of liabilities, they have managed to lock in mortgage rates, pretty low for the next maybe at least 10 to 15 years. And so there's a lot of research saying that effective mortgage rates have actually stayed really low despite the rate hikes. And on the right side, similar story as well. Corporates have managed to refinance, but the risk here is that things sort of happen with a lag. Economists like to say that monetary policy happens with long and variable lags, and we are seeing, debt service ratio for U.S. corporates inching up. I would say that it's very differentiated depending on what kind of companies you talk about. As I've mentioned, the large listed corporates in the S&P 500, they tend to have much cleaner balance sheets. But the smaller guys, the private sector, the SMEs, may be facing some refinancing difficulty, especially if interest rates get repriced with a lag in the next 12 to 18 months. So this is something to look out for in terms of risk. The last reason is why is this time different is I think this is a very important sort of point that may go underappreciated, is that the Fed has been a very effective backstop from a liquidity point of view. As you know, the Fed has not just engaged in interest rate hikes, but it has also done quantitative tightening, which means they are reducing the pace of treasury purchases. If you look at the left chart, this is talking about the Fed's balance sheet. Usually when the Fed does QT, you can see that the blue line, the securities line, is coming down, but usually it acts as a tightening effect, or it drains liquidity by reducing bank reserves, right? And if you look at the right chart over there, there is an uncanny correlation between excess reserves and risk assets, right? And why does bank reserves not go down? In fact, it's gone up. It's because there is still a lot of excess liquidity parked at the Fed in terms of reverse repo facilities. During the pandemic, the government of the US have obviously pumped in trillions of dollars of liquidity, and the Fed basically created a new deposit facility called the reverse repo for money market funds to park their excess liquidity at pretty high interest rates. And so even though the Fed has been doing QT, the additional treasury issuances have been able to be absorbed by the drawdown of this reverse repo, which is why it has not affected bank reserves. And last year, we also had the small and regional banking crisis, and the Fed has done BTFP, which is basically a bailout fund for the regional banks. And so that's why you see the orange line, which is the loans from the Fed to the banking system, has also gone up a little bit. And so the point here is that compared to the GFC days, the Fed has been much more decisive and aggressive in terms of backstopping the financial system. But still, there are lots of risk. With the expiry of the BTFP in March, we initially sort of anticipated some volatility in the small banking sector in the US, but things seems to be holding up pretty well. But it's still not guaranteed that the small banks in the US are out of the woods, because their mark-to-market losses in terms of the treasury securities is still quite significant. But anyway, the point is that the Fed has been much more effective in injecting liquidity when volatility occurs. So on the inflation front in the US, things are moving on pretty well. You can see that the labor market has been moderating and cooling. Vacancies have come down, and the so-called vacancy to unemployed ratio, which is a measure of how imbalanced the labor market has been. It's been more balanced, I would say, the past year, and that means that wage pressures are cooling off quite gradually, the top right chart. But what's concerning is that the inflationary pressures are still quite sticky, right? Even though on an annual basis, inflation is coming down, but on a sequential basis, if you look at the bottom right chart, core services inflation is still at a pretty high run rate compared to pre-pandemic. And so this is something that the Fed is concerned about. And so we had a very strong jobs report last Friday for the month of May in the US. In fact, wage pressures have picked up a little bit. And so I think the street has sort of really drastically dialed back expectations of Fed rate cuts for 2024. And so initially we had 3 rate cuts starting July, and now we only expect 1 rate cut from the Fed in November. Next year, I think we are expecting maybe about 1 cut every quarter, but next year is still a long time away. A lot of things can happen in between. And so the point is that, inflation is coming down, but it's still uncomfortably high. And so if there's going to be any rate cut cycle from the Fed, it's probably going to be very short and not as deep, unless, of course, another shock occurs, right, in terms of a recession. So in the longer term, the key risk for the US economy is, this is a well-documented sort of story, but fiscal and debt sustainability. We all know that the US debt path is not sustainable. And especially since 2020, with trillions of dollars being pumped in, not just by the Fed, but also by the government as well. And so you're seeing that on the right chart, this is projections from CBO. And the US debt to GDP ratio is really expected to explode higher in the next 10 to 20 years. I think interest payments alone will probably take up close to half of federal revenues in years to come. So this is definitely not a conducive backdrop potentially for the US dollar, and because of, you also have geopolitical dynamics complicating potentially the status of the US currency as the global reserve currency. But this is more like a slow-moving sort of development. We don't expect the US dollar to be usurped anytime soon, but it's definitely a concern given that the fundamentals in the long term for the dollar is potentially weak. But for the meantime, make hay while the sun shines. US capex is picking up again. Like I said, global expansion is slated to continue. And so, US capex, because we are Asia economies, how does the US affect Asia? It's traditionally and historically always through trade, because we are trade dependent, and our major customers are still in the US, and demand is from the US. And so, the US capex cycle continues to drive Asian exports I would say, in the next 12 to 18 months. And so why do Asian exports matter so much? Because it literally drives Asian currencies. If you look at the left chart, there's a very good fit between regional exports as well as the ADXY, which is the regional currency index. And so we do tentatively expect Asian currencies to make a rebound in later part of the year. Maybe not now, because we are still waiting for the first Fed cut. But if everything goes according to plan, according to forecasts, then we do expect some rebound in Asian currencies, maybe towards the end of this year instead of the third quarter of this year, with some differentiation, of course. But within Asia, not every currency is going to appreciate or recover, to the same degree. We can see that since the pandemic, there's been quite a bit of differentiation in terms of the recovery profile in Asia. Really, it is the tech producers that's been dominating the recovery. If you can see, the tech production it obviously came down a lot because of excess inventories, but a lot of the producers have actually destocked quite a bit. So right now, they have much cleaner inventory profiles. And so they are actually recovering quite well, especially the countries and producers that are more leveraged and in position to take advantage of the new industrial revolution and also the 5G AI secular trend, right? But the non-tech producers, unfortunately, which I think is more leveraged towards domestic demand, has not been recovering as well as the tech sector. And so you can see, in terms of countries on the right chart, Korea, Taiwan doing very well, but not so much other Asian countries. So talking about Asian FX, it's not just trade that matters, but really interest rate differentials to the US. And for the first time in a long time, average Asian interest rates are actually lower than the Fed right now. So we are in a negative rate differential territory. And even though the Fed, as I've said, will likely cut, it wouldn't cut a lot. It might cut one or twice this year. And so this negative rate differential regime could persist for some time. If you look at the right chart, a lot of countries are actually experiencing record negative rate spreads with the US. And so there will also be an offsetting drag to Asian currencies, even though exports and trade are still expected to hold up by and large. So that's the US view. The second big puzzle to solve, so to speak, would be China. And for China, the story hasn't really changed much over the past 12, 18 months. As you know, the government authorities have been easing policy gradually, sequentially, in terms of housing, fiscal, monetary, et cetera, but the concern here is that the policy effectiveness has not been that great. If you look at the right chart, ultimately, it's coming down to the real estate sector in China. It's 20% of GDP, and historically, whenever there is a downturn in China, the playbook is just to pump cheap credit into the banking system and hope that it will flow into developers and mortgage takers. But as you can see here on the right chart, the real estate sector has not been reacting at all to triple R cuts. And the reason is because most of these major developers, property developers in China, are still pretty much in distressed territory, and they are not even close to really deleveraging and cleaning up their balance sheets, right? So as long as that's the case, then it's really difficult to see a proper reflation in China. And also you can see that retail sales and services are still doing pretty, not badly, but the recovery has not been that great. That's also down to how weak the property sector has been. And I think another point is that there is policy and regulatory certainty is less in China nowadays. As you know, the government has been tightening its screws on the private sector and entrepreneurs since 2021. And so even though they are not doing that as much anymore nowadays, but I think the so-called private sector animal spirits and confidence is still quite downtrodden, right? Which is why we see not just FDI getting out of China, but even domestic investments, especially from the private sector, is pretty soft as well. And so how does China affect the rest of the region? Primarily through two channels, trade and services, services meaning tourism. And so that's why, because domestic demand is quite weak, we see that Chinese imports from the rest of the region is still pretty soft, even since the reopening in end of 2022. But what has been normalizing pretty well will be tourism. So the usual suspects like Thailand, Vietnam, Malaysia, Singapore are benefiting from the normalization of Chinese tourism. But there are some concerns. I cover Thailand as Economist. Even though we are seeing the quantity of arrivals normalizing, but it is the quality of spending that is lacking. And I suppose that also might go back to the weak economic situation in China. So even though people are traveling, but they are actually sort of downgrading their spending and their travel purses, right? Another channel that China affects Asia is through the currency channel. And so you can look at the right chart over there. Since 2015, since the PBOC has switched to a trade-weighted, CFETS FX regime instead of just purely targeting the US dollar, correlations between the CNY and Asian currencies have really gone up a lot, right? And this is in addition to stronger trade and investment linkages between China and the region. And so, basically, Asian currencies are also a function of the Chinese currency, and if the Chinese currency does not rebound soon or weaken from here on, then it will also pose a huge drag to the rest of the region as well from an FX point of view. In terms of monetary policy, we talk about inflation. US inflation is coming down, but still pretty sticky. But actually in the region, inflation has been coming off quite nicely. And a lot of the regional central banks, inflation is actually back to target, right? With maybe a few exceptions. And it's because in Asia, inflation is very driven by food and commodities and energy, right? So obviously, since the Ukraine crisis, you have a big spike in energy and food prices, but the supply side shocks have been fading and dissipating quite a bit. Of course, things are not certain yet. We still are in a very tricky situation, geopolitically speaking. But most importantly, what we are noticing is that core inflation, which is really a function of labor market outcomes and domestic demand, that's been softening gradually. And so against this backdrop, we think that central banks in Asia do have the space to cut interest rates this year. But again, it depends on what kind of economy. I think the likes of countries that are in deficit territory, where the so-called reaction function of the central bank is sensitive to the US dollar interest rates, external conditions, may not be able to cut as much. We're talking about the likes of Indonesia, Philippines, etc. Right? And for other countries which are in a surplus territory, they can cut, but really those countries have not been hiking as much as well. We're talking about Malaysia, Thailand since the start of the pandemic. So overall, we basically see the ability for central banks to cut, but not as much as they would like. We have a very constructive view on gold, not just on a cyclical, but also on a structural basis, right? This is sort of a multi-factor regression model talking about what explains the movement in gold prices from a financial investment point of view. So there are 4 key drivers. The most important is US real interest rates, as most of everybody know. US real interest rates sort of move in a negative fashion with gold, right? So the higher real rates are, the lower gold prices and vice versa. And the reason is because gold is a zero yielding asset that competes with fixed income and bonds, right? And so that explains the negative correlation. And on that front, even though we do not expect a very sharp rate cut cycle from the Fed, but we do think that policy rates have peaked and yields have peaked. And so chances are, US interest rates will grind lower in the next 12 to 18 months, which should be a cyclical tailwind to gold, right? The second factor is the US dollar. Once again, is negatively correlated with gold. The reason is because gold historically is the world's oldest currency. It is, it has fixed supply. It's most importantly, it's what we call anti-fiat currency, right? And so it's a very good hedge against, increase in money supply, right, by central banks and by U.S. governments, by global governments, etc. And so over here, even though we do think the US dollar might hold up because interest rates won't go lower too soon and US growth is still pretty okay, but as I've mentioned, the key risk for the US in the medium to long term is fiscal lack of fiscal orthodoxy, right? And so with higher US debt, and the central bank balance sheets expanding over time, money supply will also keep increasing, and so there obviously it makes a lot of sense to hold some gold as a hedge against a potentially weaker US dollar in the future. The third factor over here will be what we call US high yield credit spreads, and that's really a proxy of risk aversion, right? And so usually credit spreads are very sensitive to economic conditions. If there's going to be a recession, spreads will go up and gold will rally, right? And so that explains also the negative relationship between credit spreads as well as gold. The last one is global policy uncertainty index, and that really is it really reflects the geopolitical environment right now. We talk about trade wars and trade tensions, US-China secular tensions. Whether Biden or Trump wins in the fall, we think that it doesn't do much difference in terms of the US-China relationship, unfortunately. And so that, once again, gold will be a pretty good hedge against elevated geopolitical risk. So if you plug in the latest numbers of all these 4 factors, the fair value of gold is only $800, but right now it's trading at $2,300. So there's a huge valuation premium over there. The reason is because central banks, especially in the emerging markets, have been really snapping up gold purchases and diversifying their reserve holdings from treasuries to gold, right? As you can see over here in both these 2 charts. And I think this is a structural trend that will continue. And so there's a reason why I think, in a way, the stars are sort of aligned for gold to potentially break out higher in years to come. And if you talk to our commodity strategists, their forecast for gold, I think, is about 2,500 by end of this year. Currently, it's about 2,300. And so we are still very bullish gold going forward. This last slide over here is just talking about what usually happens to gold in a rate cut cycle. And so you can see that on the right chart, usually gold would do quite well, right after the first rate cut from the Fed. And the Fed usually cuts when there is a recession or something wrong in the economy, and so gold would naturally outperform as a defensive asset as well. So I'm just going to stop here, and thank you so much for your attention, and have a great rest of the session. Thank you.
Any questions for our keynote speaker, if you have?
You had a question about potential rate cut, U.S. of course, in November. Are you thinking before the election or after the election? Because that would be really, really
That's
dangerous.
That's a great question, yeah. I don't really know the specific dates for FOMC in November, but it is kind of it will be very surprising if the Fed cuts before the elections because they want to come across as an independent central bank, right? And so if they do cut, before the elections, it may be seen as boosting the incumbent, right, to some extent. But even if they cut in November, I think it's too late to benefit the US economy before the elections, and which is why I think we have basically priced out July and the rest of the third quarter in terms of rate cuts, right? And so I think it's still very uncertain when the Fed will actually deliver its first rate cut. The market is pricing 1 to 2. And so it will be, to answer your question, I think it wouldn't look good for the Fed to cut, I would say significantly before the elections, right? I think November is still okay, even if it's like 1 or 2 weeks before the elections. But I think historically the Fed has really been quite quiet in the, I would say 3 to 5 months before an election, yeah.
Thank you very much, Mr. Jin. That was indeed excellent.